Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, you can find us at zinniawealth.com. You can hit that gold box there when you go to the website. It says complimentary retirement consultation. That gets you started. If it's time to have the conversation about your retirement, how the money's going to work, well, that's a good place to start. zinniawealth.com or 833-368-3680. All right, Sharice, every now and then I'll bring to you a Susie Orman clip, or I'll bring you something from Kevin O'Leary from Shark Tank, or I'll just give you something like that and just get your comment on that. Well, we all know Clark Howard. Clark Howard is a consumer advocate, and he's done a lot of great work, kind of like a Dave Ramsey, and he's helped people save money. Well, he was just recently asked, how should people save for retirement? And he said some good things, and then my ears perked up when I heard this.
After age 50, you're even allowed to put in mega dollars beyond what somebody younger than 50 can do. Put the money in a simple fund. My favorite, a Target retirement fund.
That's good.
Okay, so that was my little addition there at the end.
Okay.
All right, so target date funds. This is not the message that I hear from Sharice. You're not a fan. Clark is. What's the problem? Why do you disagree?
Yeah, so we get a lot of these talking heads. Susie Orman, Dave Ramsey, Clark Howard. They pose themselves as financial gurus on top of travel gurus. You can't be a travel discount guru and a financial guru. Like, did he read something? He needs to go back and ask ChatGPT because the ChatGPT gave him the wrong answer, right?
Okay.
Anyways, I love Clark Howard. And
I do too.
I do. I go to his site once in a while. I'm like, what is the best credit card out there right now with points, right? So I do that. So he's got his wheelhouse and he's fantastic, right? But some of these gurus, they are not giving you good advice or let's say the best advice. They are giving you average advice.
So what is a target date fund? First,
Yes.
Tell us what that is and why you don't care for it.
Yeah. So Clark's speaking for the masses to keep it simple. Target date funds, the closer you get to retirement, the more conservative it gets. So when you get closer to retirement, it just says, hey, we're going to move out of equities a little bit each year and move over to bonds. So people just didn't make any money on sometimes 40% of their portfolio during that time period. Then they're wondering, well, why didn't my target date fund do it? Well, it made you more conservative as we're going up and down this hole in interest rates. Bonds took a bath and it's still not doing what it needs to be doing at this rate. Mm-hmm. And so it's an automatic shuffle. So like a 2030 target date fund, well, that means you're retiring in 2030 and you're going to be nearly 100% in bonds or fixed income. But what I've found out is that 2030 fund still has plenty of equities and it actually takes on a little bit more risk than I would have expected, to be honest, at the end of the day. I am not a fan of target date funds. I'd rather you have a pick of mutual funds, but most people don't know what mutual fund to choose or how many and which ones at the end of the day. And most 401ks have a very small menu, Randy. Mm-hmm. So you'll see maybe 30 funds total, where I have access to 30,000 funds. So it's easier for me to pick and choose. So when people come in, they'll get a 401k portfolio review, and I will make recommendations. Our advisors will make recommendations. Hey, we don't recommend this target date fund because of this. And we can go inside that target date fund and show you why. And we'll say, why, instead of going that direction, if you want fixed income, let's not go with the long-term bond. Maybe we could pick the short-term bond they have as an option. So you're making that decision. Or maybe if interest rates shift gears, we're like, no, let's go with the long-term bond, not the short-term bond, right? So there's a lot of these things. And the average investor that's putting money in a 401k, they don't want to know how to do it and they don't care. So Clark Howard, the target date fund, is an easy story. But when you're getting close to retirement, the easy story doesn't always win the race. And if you are that person that says, hey, I want to hit that number, I want to get to $1 million, you might be in the absolute wrong strategy in that target retirement date fund, right? So there's so many reasons why to come in and get that 401k review from us. I have a lot of clients that still have 401ks. They've moved some stuff to IRAs because some of those retirement date funds were doing nothing. And so we were able to roll them to our IRAs and manage. And then they were still able to keep their 401k, but we are managing their 401k saying, do this, or the other. So just taking action, being proactive, getting ready to retire, and try to make the best moves as possible because you're good at what you're good at. I'm good at what I'm good at. Let me tell you what to do.
Well, we would love to have the opportunity to talk to you about it. When you hear things online, when you see somebody say something, you go, well, is that true? Bring it into Charisse. Let's get an opinion there, and she can tell you some of the math that goes along with it. If you see those things in your 401k and it says target date fund 2030, 2035, 2040, I'll bet you'll find them in there. Are those a good place for your money? Well, we can talk through that. Give us a look on our website, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box that says complimentary retirement consultation. Click on that. You'll be on your way. Or you can bypass all that and just give us a call, 833-368-3680. All right, so when we talk about our website, if you go there, zinniawealth.com, there's a button up there that says Contact Us. And when you click on that, it'll bring you to the contact page. You scroll down a little bit and you'll see Question for Zinnia Wealth. And you are welcome to ask a question that we will handle here on the show. In the meantime, I love to prowl around in all the advice columns where people ask questions. This one came from Smart Asset. It says, my dad left me $675,000 in an IRA, but I'm in the 32% tax bracket. How should I structure my withdrawals? Now, Charisse, this is what you talk about when you say the widows and the kiddos penalty. What kind of pain is this guy in for, and how do we help him avoid it?
Yes. So what we are educating on radio about right now, today, why aren't we considering rolling some of our IRAs to a Roth IRA while the retiree is potentially and most likely in a lower tax bracket than the person inheriting your money, right? And the surviving spouse at the same time, because when we pass away and there's one spouse living, our taxes go up and our deductions go down. Tax brackets go up, thresholds go down. And so you're protecting the surviving spouse, but you're really protecting the kids because you're probably thinking $675,000 in IRA. Well, what does that really mean in math, Sharif? This person has an income coming in and he's paying taxes at marginal tax rate up to 32%. That's pretty high. Mm-hmm. So what does he have to do? Number one, the law says you have to take a percentage out of that IRA that you inherited for the next 10 years, a small percentage. And then by that 10th year, all of that money has to be out. You have to pay all the taxes on that money. So what is happening is most people are dividing that value over 10 years. And if we're assuming there's no growth, which there will be growth, but if that's the case, that's $67,500. So multiply that by 32%, Randy. That's if the taxes are still at 32%. And he could be in a higher tax bracket. I don't know if he's just barely about to hop over to the next tax bracket. So I'm being fair since I don't have enough information. So that tax bill, the extra tax bill, because he has to take that $67,500 out every year for the next 10 years, and that's going to go up because we're going to make money. That's $21,600 over 10 years. That's if taxes don't go up. That is a total of almost $220,000. So that $675,000 that dad left for their kiddo, they're only keeping about $460,000 of that.
Oh, boy.
And if I could have worked with that client prior, 10 years prior, said, hey, let's roll half of it. Hey, what would it cost us to roll it all? Because maybe he's only in the 12% tax bracket. Mm-hmm. And then if he hopped over the 22% tax bracket, it's still, you have worked so hard for your money. You are just letting Uncle Sam steal your money from the surviving spouse and the kids who inherit this money. This money is for them if you haven't spent your last dollar on your last breath. And we are allowing Uncle Sam, your partner in these 401ks and retirement plans, to take ownership and rule your household. And I think it's BS and it's aggravating. And I am getting people today to really do massive major conversions. Everybody who comes to my office, it is happening. We're doing these amazing tax plans. They can see the math for the first time and they understand it. It's so simple. Because this beneficiary, doesn't dad want their son or daughter to keep that extra $220,000? Of course, that $220,000 you worked your butt off for, and now you're giving it to your silent partner, Uncle Sam. So I do get a little frazzled here because we're seeing it in math. We're seeing it in a math equation. And what if you have $1 million or $2 million? I had the client just walk in with $3 million in IRA accounts. We got a lot of work ahead of ourselves, right? So there is a math equation, and most people should be considering rolling IRAs to Roths if you want that beneficiary to keep more of your money. And if you don't have beneficiaries, if you want it for a lifetime to have tax-free income in the future, if you have a long life, if you're giving this money to charities when you pass away, then it probably doesn't matter so much, right? If you're a single person and it's going to charities, hey, well, they don't pay the taxes on it. So there's always a rhyme and a reason. We just have to figure out, what are your wishes? What are your goals? What do you want this money to do for you when you have passed away? What do you want this money to do for you once you've passed away and maybe you have a spouse and they're still alive and they live another 10 to 20 years? I mean, they're going to have to deal with this tax burden, and it is rough. And people are paying an average of $10,000 to almost $20,000 more a year when one spouse passes. And then that tax burden is awful. My buddy calls it the widow's penalty. And then you got the kiddo's penalty. You're seeing the math here, right? So does it make sense? I want you all just to stop and think, does it make sense to come in and do a tax plan with Zinnia Wealth Management to decide, do I or don't I? Because I have time now. And if you are under 59 and a half, you can do this also. Okay. And we'll teach you how.
It's very common. You're in your 50s or 60s, your parents are in their 80s, and they pass, and you are in your highest earning years, and they send down inheritance to you in the form of a 401k or a IRA. And now all that money gets added onto your income. It's crazy.
Top of that, Randy, that person who's having to take almost $70,000 extra a year, he might very well be paying $185 a month for his Medicare.
Yeah.
But for the next 10 years, he very well might be paying $550 a month for his Medicare once the 2-year look back starts. So there's that added cost there. So lots of things to consider. We call that the IRMA rules and knowing where we're at. So also remember that back end deal.
Well, we want to give our kids a leg up. We want to give them some inheritance, but don't be bad Santa. Don't be that person that gives a great gift and attached to that gift is a big tax bill. That's not what you want. Give us a call. Charisse has the software. She can do this for you very quickly. Not only will it compute whether you're a good candidate for it, but it'll also show you that schedule of how much you would want to convert per year so that you don't get into tax problems yourself. All of that available to us with our complimentary retirement consultation. Give us a call. We'll do this for you at no charge. ZinniaWealth.com is our website. Hit the gold box. You'll be on your way there. Or 833-368-3680. All right, so here's a little test for you. I want you to look at your balance in your 401k. You see that number? It's a good number. Now subtract 10%. Ugh. Now, that doesn't feel too good, does it? Now, the reason I say that is 10% down is a natural and normal occurrence in the stock market. On average, it happens about once a year. And folks, it's been over 300 days since we had the last one, so we're due for this. So we haven't had a major pullback in the market in probably 4 years. And now 2008, we all remember that. That is now 17 years ago. So, Charisse, I want to ask, do you think people have a little bit of financial amnesia? They've seen the market go up for so long, and they forget that the market can go down, and they're not ready for it, and they might get caught flat-footed if they're a little too far at risk. What do you see when people walk through the door?
Roller coaster. You remember those things?
Sure.
Kind of nowadays, I get dizzy when I'm on a roller coaster. I used to not, but my stomach would end up in my mouth when I was younger, which was fun. So we do a portfolio x-ray, and we look at where people are today based on their age. And we're sitting across the conference table, Randy, and on paper, when we do this portfolio x-ray, they are invested like they're 35 years old, but yet they're 65 years old and they don't know it. And most people are like, well, Charisse, like, I didn't know that. I thought it was, I told my people I wanted to be more conservative. So we give that second opinion review just so you know where you're at, because we've said many times before, everybody's trying to catch the tail of that rocket ship when it's going up, but eventually you're going to be burned. And it's okay to be burned, but not if you're living on the income. And I still don't think it's okay to be burned. Those things hurt. But I will say this. I like to look at it in dollars. 2008 is a long time ago, almost 17 years ago.
Yeah.
And everything's looking great. Markets are going up. There's a lot of noise out there about, we've gone up so long. Now we have a new president, Donald Trump, and I feel like the market could do really well, but I feel like it's going to be volatile. A lot of people are feeling like the market could be volatile. So I'm glad people are feeling that way, because when you're not feeling that way, we find out people are taking too much risk and they're going a little too far into the weeds and overexposed to the stock market. Because if you had $1 million, the market took a bath over the next 2 weeks, and you got burned by the fire of that rocket ship, and you lost 20%, 200,000. Now that million's 800,000. How would you react? And the risky investor would be like, no, sell, sell, sell. And before it was always hold, 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 buy, buy, buy. So we're seeing a difference, because we're saying dollars. You're losing this much in dollars versus just 20%. People react differently. They change their minds when they see that number, which is pretty critical to use real numbers, not just percentages. But 20%, typically we can tick right back up in a year and a half, no big deal, right? It's when we hit the 30%, the 40%, or even the 50%. Those are the ones where it can take 4 to 5 years to get back to even. And if you need that money to live on, the cardinal rule is you shouldn't be touching it. You should be pulling money from something that didn't go through that roller coaster ride. So something that was safer. Maybe it's CDs, but you need to have 5 years of income sitting somewhere so you don't touch those dollars. So there's nothing wrong with having risk, Randy. It's just making sure not to have risk on the dollars you're living on. I would just get control of your destiny of enjoying retirement, enjoying it the way you want to, and making sure those dollars show up every month when you're booking those trips.
Well, we talk about three main things that we've got to have in our retirement plan: protection, income, and growth. And if you look at it like a pyramid, throughout your entire life, the top priority has been growth. That's the top. And then the middle of the pyramid's probably been protection, and the bottom is income. You don't need income right now. When you get into retirement, that flips. And you need income at the top, you need protection, and at the bottom of that pyramid, maybe you need growth. We need to figure out where you are on that scale. If you're too far out there above your skis as far as growth and risk is concerned, that's something that we can find and identify in our complimentary retirement consultation. We'll dive in there and find it. Give us a look, give us a call. Here's our website, zinniawealth.com. There's a gold box there, and it says complimentary retirement consultation. Click on that. You'll be on your way. Or 833-368-3680. All right, this is one of the things that Charisse constantly talks about. We get a plan in place, the income is there, and we set our retirees free. Go have some fun, do the stuff you want to do, and they don't do it. Why don't they do it? They still aren't in the mode of spending. They still are afraid. And there's a survey out there right now that says here's 3 reasons why people don't spend in retirement. Number 1, they want to leave money to their kids and their grandkids. Number 2,
that's nice.
They lived through COVID and they learned how to stay in and not travel. And
that's
so
boring.
They're okay with it. And number 3, the fear that they'll get sick or live too long and they'll run out of money. So let's address that, Charisse.
Yeah.
I know you've told me stories many times where people have come in for their 1-year review and you say, did you go on your cruise yet? And they say no. And you say, don't come back here till I see tickets in your hand.
So true. So true. I'll make you accountable.
All right.
So I want to hit the first one. They want to leave money to their kids and grandkids. I'd love that. That is so sweet. I mean, it really is, because to kids and grandkids, there's going to be a lot going on, and they very well might need it. I'm okay for it. But I'm pretty sure most of you listening to this show, you didn't work for the last 40 years of your life, pinch pennies, clip coupons, maybe not to drive the car you really wanted, to save for this day. They call it the golden years, to not spend money and to not travel the way you should and enjoy those years because it goes to grandkids. So I just want you to rethink that. Your grandkids, your kids, they're going to be mad that you did all that and you didn't get to enjoy it the way you deserve to And so I get it. And if you come in and we do an income plan, we'll build this out for you. We're going to show you how you can spend during those years that you deserve to, why especially you have your health, and still leave money to a beneficiary or a beneficiary. So we're going to show that to you based on your assets, what you've saved, your fixed income, and your liabilities if there are any. So, we'd be happy to do that. But I don't want you not to spend, because that's the most important thing. I want you to do both. And can you do both? And you probably don't know because you're thinking you can't, because you've never seen the math. So we do the math here. I want to show you the math. I want to encourage that person that's like, Sharice, I do want to see the math. Call us. Number 2, COVID. Randy, this one's huge. Whenever a new person comes in my office, they're like, literally every day, we just haven't really gotten back on the wagon of travel because of COVID. Mm-hmm. And as soon as they come into my office, they must listen to the show. They're like, we know we got to spend. We know we're going to travel because I know you want us to. And so we started working on a plan. Before you know it, 3 months later, they already have 4 trips booked because they haven't spent that money and it's sitting there and you can't be buried with it. And so we're seeing more people. It's ticking up, but people have gotten comfortable in their homes and doing things at home, which is fine. You're saving a lot of money, but get back on the horse and get back out there and travel. It's a good time, and spend some of that money that you've earned your entire life. So I wouldn't be afraid of that. Now, this is the big one, Randy. Mm-hmm. Number 3, final one. We don't spend as much money in retirement because the fear we will get sick and or live too long and run out of money. So I want to take all the listeners out there. Go ahead. If you're in the car, stop and get a pen, get a calculator. If you're at home, just settle in. Take the amount you have saved. Let's say you're 65 years old. Mom and dad never lived a buck past 81, maybe 82. You're feeling healthy. You might be able to go to 85. That's 20 years. Take the income and the spending you need for the next 20 years. Add that up year by year. Just multiply it by 20. So if you need $50,000 extra of income coming out of your assets over the next 20 years, multiply that. If you have that exact amount of money sitting in those accounts, you're probably not going to run out of money, right? That's with no returns whatsoever. Now, if you have a whole lot more, now you can spend some bucks and do some stuff or leave a bigger legacy or use those extra dollars for long-term care. So this is all simple math. We actually do put a calculator and put it on a big screen and show you how it works. We will adjust your income every year going up with inflation. We'll show it on a very conservative rate of return just so you can see where you're at. But don't fear running out of money because you're going to get sick because you have Medicare. We can talk about long-term care. And if you are somebody who is a candidate to go buy a long-term care plan or a life insurance plan with a long-term care rider, and or we work on elder planners and their trust strategy. So there's a lot of things that can be done. So, and it's not too late if you're like, Teresa, I'm older. I can't get qualified. It costs too much. If there's a will, there's a way, and I am your will, and I will find the way. So trust me on that. I always have. Now, and going back to running out of money, I'm going to prove to you that you're probably not going to run out of money. I will say, hey, you're getting close to the red at the age of 90 years old. If you happen to live this long, we might want to pull back the reins 10 years prior, probably when we're not going on as many trips or doing as many things. So we want to show this to you. Just don't assume it. You have to put the math together, and we have a real special way to show that to you for free.
One of the things that we find is when you get into that saving mode, it's hard to get into the spending mode. And it takes people a little bit. And when they start to see their accounts go up, they go, well, we better go spend some of this money. And that's exactly where you need to be and have the confidence to go out and do that. And that's what it is, to have a retirement plan, to have an income plan, to know that that bucket's going to get filled up every month. That's what you want. in retirement. Give us a call. Let's give you that kind of confidence. Here's our number. Here's our website, ZinniaWealth.com, ZINNIA Wealth.com. There's a button there. It's a gold box. It says complimentary retirement consultation. If it's time to talk about your retirement, let's get that conversation going. You can bypass all that and just call us. Set up a date on the calendar. 833-368-3680. Again, 833-368-3680.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.